Hey guys, can you believe it? Those gold bars sleeping underground in London for centuries might just grow QR codes next year and turn into live money in your phone. Not Bitcoin, not USDT, but digital gold backed by the World Gold Council itself, PGI. Last week, on September 3rd, COMEX gold broke through $3,630, and spot gold hit $3,565. My social media feeds were flooded with gold prices are going crazy, but what's even crazier is that World Gold Council CEO David Tate told the Financial Times that London will pilot pooled gold entitlements next year. As soon as this news broke, EBS rushed to raise its gold price target to $4,000 for next year. Morgan Stanley straight up declared that gold rises an average of 6% in 60 days during rate-cutting cycles, the real bombshell, allowing investors to hold digital ownership as small as 1,000th of an ounce. That means a 400-ounce good delivery gold bar can be split into 400,000 pieces. You can buy in with just tens of dollars and even use it as collateral with brokers to add leverage. Sounds like an angel round story, right? But stuffing the ultimate safe haven asset into blockchain. Is this about making gold great again or tearing down its last moat? I'm Luna here to break down macro trends into numbers that hit your portfolio. Today, let's talk what exactly is PG, why is the World Gold Council launching it, and what are its pros and cons, how is it different from gold ETFs? Since you're still not holding physical gold, will its emergence impact Bitcoin investments? And finally, let's get to what we care about most. How can retail investors grab this opportunity? After watching this video, you'll see that PGI isn't just another product update. It's a $930 billion gold market making a last stand. So in the cracks of dollar credibility, if you get it, you won't just predict gold's moves. You might snag a ticket to the next great wealth transfer. Subscribe first, then watch. Good habits lead to good returns. First, we gotta understand what exactly is PGI. Cutting through the jargon of pooled gold entitlements. Put simply, it's giving every gold bar in London's vaults a digital ID. As of June 2025, London's vaults hold 8,776 tons of gold, about 700,000 bars, worth $927.5 billion total. And all of this will be PGI's underlying asset. So every PGI you buy corresponds to partial ownership of these real bars. If there's a run, you can redeem with your certificate. It's not like Bitcoin and Aircoin with no physical backing or virtual gold issued by some platforms. You can even check which exact bar your share corresponds to, which vault. It's in its serial number, more reliable than the unallocated gold we used to buy. Remember how hard it used to be to invest in gold. Either you had to shell out big bucks for a whole 400-ounce bar. Forget the principle, just storing it was a headache, scared of theft at home, paying custody fees at the bank. And when you wanted to sell, you had to find a buyer, verify the gold. Transfer ownership, a process that could take half a month, even if things move fast. Or you bought unallocated gold from banks. You had a number saying how much gold you owned, but you had no idea where that gold actually was, which bar it was. If the bank misused the bars or something went wrong, that number in your hand could become worthless. But PGI solves these two major pain points. First, the barrier to entry is so low, everyday people can get in. You can start with 1,000th of an ounce at $3,600 per ounce. That's just $3.60 per unit, about 25 yuan. Even if you save 100 yuan a month, you can buy 4 units, building yourself a little digital gold stash. Second, it's secure. It's independently custodied, not controlled by any single institution. You can trace your portion of gold on the blockchain. Every step from mining, refining to storage is recorded, like giving gold a birth certificate and passport. No worries about misuse. Third, it's flexible enough to be live money before. Gold just sat there as dead money, waiting for the price to rise. No other use. But PGI can be used as collateral. If you need cash fast, take your PGI to the bank for a loan. Get funds the same day. No waiting like selling physical bars. It might even be used for cross-border payments. Later buy something abroad. Pay directly with PGI. No need to exchange currency. Avoiding exchange rate risks. Mike Oswin, Global Head of Market Structure and Innovation at the World Gold Council, said, "We want to make gold as flexible as bonds. It used to be sleeping assets on balance sheets. Now we're bringing it to life, making it tradable, collateralizable, and profitable." At this point, some might ask, why digitize gold? Is the World Gold Council bored or something? Actually, there's a bigger logic behind this. The gold market today is no longer just about buying and waiting for appreciation, and it's driven by major shifts in the global economy, especially the Fed's interest rate policies and we're all watching, which are also pushing gold toward digitization. Why do I say that? Hold on, let's break it down first. Fed Chair Powell turned dovish at the end of August during Jackson Hole. So even though inflation hasn't hit the 2% target yet, the labor market is already softening. July's non-farm payrolls only added 73,000 jobs, almost 40,000 less than the expected 110,000. This suggests the U.S. economy's foundation is starting to crack. On August 29th, the U.S. released core PCE inflation at 2.9%, still high, but falling according to the CME FedWatch tool as of last Friday. The probability of the Fed holding rates steady in September was just 0.6%, while the chance of a 25 basis point cut was as high as 99.4%. Some are even saying there might be another cut this year. Historically, every time rate cuts happen, gold gets the first sip of the soup. Let's look at the data after the September 2007 rate cut. Gold rose 56% in 12 months. After the 2019 cut, it gained 6% in 60 days this time. Wall Street has already written the script: a weaker dollar, falling real rates, ETF inflows returning, physical demand recovering, gold is headed for $4,000. And coincidentally, the World Gold Council chose this exact moment to launch PGI, essentially using rising gold prices as a customer acquisition strategy. Scared of high prices, will break it into pieces for you. Throw in leverage, and even 0.1 gram can get you in. So retail investors, hedge funds, and even investment banks desperate for high-quality collateral are all eyes wide open. PGI hasn't even launched yet, but the comment section is already exploding. Gold. Purists are furious, calling it a betrayal of physical attributes. Crypto folks are mocking it as old-timers trying to ride the blockchain wave and leverage. Players are just asking, how many times can it be collateralized? When these three emotions collide, the viral code is born. But the real story lies beneath the emotions, cracks in dollar credibility. Consider this: U.S. national debt has exceeded $37 trillion, with a fiscal deficit rate of 6.3%. On the other hand, global central banks have been net buyers of gold for 10 consecutive months, with the PBOK buying for 18 straight months, accumulating over 300 tones. Old Bond King Bill Gross bluntly said, the dollar system is overdrafting its credit. As trust in sovereign currencies becomes costlier, gold's value as the ultimate no counterparty risk settlement tool shines. But here's the awkward part. Traditional London market delivery of a 400-ounce bar takes at least 5 days plus transportation insurance weighing, and assaying that it can't keep up with crisis speed. The emergence of PGI is essentially packing the ultimate safe haven asset into an instant settlement, shell blockchain record keeping, physical gold bars staying put, and ownership transferring in seconds. Theoretically, even the Fed's reverse repo RRP pool could be used intraday collateral. In short, for the first time ever, gold gains the settlement efficiency of digital dollars while keeping the foundational trust of physical gold backing. Don't underestimate this step. Once global clearinghouses accept PGI, gold will no longer just be a safe haven backup, but upgrade into high liquidity, high quality collateral, directly competing with U.S. bonds. When that day comes, will gold prices simply be an inflation hedge? No, they'll become interest-bearing gold during rate cutting cycles, and valuation models will have to be rewritten. But every nuke has two sides. PGI's flip side is the devil of refinancialization. Gold is called no credit risk, precisely because it doesn't rely on any counterparty, but PG custodies bars in a joint account at HSBC, JP Morgan, Standard Chartered. So bars don't move. Legal ownership is split into digital streams. If a custodian has a Lehman-style meltdown, can investors' PG still be rigidly redeemed? Remember, 2008 AG collapse even sent gold lease rates soaring to 2%. Hukies outside London. Vaults the council's white paper promises daily bar list, a publication, third-party audit. But when panic hits, auditors can't even get in. Worse, if PGI is widely used as margin and gold flash crashes, clearing houses force liquidations, chain selling liquidity could vanish instantly. Gold experiencing a 312 isn't a dream. That day, is gold sheltering risk, or does gold need sheltering? No one knows. That's why traditional gold dealers watch coldly. And Bullion Vault says, solving a problem that doesn't exist. LBMA old-timers worry fractionalization plus leverage could repeat Silver's Hunt Brothers squeeze. History tells us, any attempt to stuff physical assets into digital leverage molds faces the same test. When extreme risk hits, can you turn digits back to physical? If the answer is fuzzy, trust falls like dominoes. So here's the clear outline of PGIs. It's neither the conspiracy theories gold paperization 2.0 inches, nor the savior. It's gold remonetization. It's a gold system upgrade squeezed by 5 forces: dollar credibility weakening, interest rate, inflection nearing retail, barriers too high, institutional collateral hunger, blockchain infrastructure maturing. If upgrade succeeds, gold jumps from static safe haven to interest-bearing liquidity, opening trillion-dollar collateral markets, lifting gold's price core. If it fails, leverage breaks, trust collapses. Gold might experience crypto-style flash crash for the first time. All right, now that we understand what PGI is and why it emerged, let's tackle a question many of you might have. Will its arrival impact previously invested Bitcoin? If even gold can be fractionalized and traded, does Bitcoin's long-hyped digital gold narrative still hold up? Don't forget, ARK Invest just gave Bitcoin a moonshot price of $1.5 million by 2030, precisely based on the gold replacement thesis. Now, with real gold stepping into blockchain transformation, is it about to flip the table? A lot of people call Bitcoin digital gold. And now, with PGI out, some are saying PGI is the real deal. Bitcoin is the knockoff, but you've got to understand they're not the same thing at all. Bitcoin has a fixed supply of 21 million coins, is decentralized, and is super volatile. It's normal to see 10% gains or drops in a single day. It suits risk takers looking for quick profits. PGI, on the other hand, is backed by physical gold. Its price moves with gold relatively stable, but also slower growing. It's for those who want stability and long-term allocation. If you confuse the two and expect PGI to double overnight like Bitcoin, you'll likely be disappointed. Conversely, if you seek stability but buy Bitcoin instead, only to panic sell during swings, you'll lose out. So ask yourself, do you want digital gold for steady gains or fast gains? If you're not clear on this, don't jump in. For us, retail investors, what matters isn't picking sides, but understanding the script ahead of time. During rate-cutting cycles, 4 major themes: gold, real estate, commodities, and fintech will take turns reshaping the game. PGA is just a new player in the gold theme. So how should we place our bets? Here's the bottom line. Don't rush in blindly. First, figure out if you're here to hoard gold or play gold. If you're preparing for extreme risks like geopolitical conflicts, a dollar collapse, or bank failures, stay away from PGI and go straight for physical gold bars or coins. Remember, only gold you can hold in your hand deserves the title of ultimate means of payment. If you're just looking to ride the rate cut wave, but find ETFs too pricey and physical gold hard to store, PGI does offer a low barrier, high liquidity option, but keep your position small. No more than 10% of your total assets, and stick to platforms listed as core nodes by the World Gold Council. For crypto natives, PGI isn't the enemy, but a new tool to hedge volatility. You could shift 30% of your Bitcoin profits into PGI, creating an on-chain gold plus Bitcoin dual engine strategy, locking in gains while keeping exposure to crypto upside. In short, no matter how digitized gold becomes, it's still a slow asset. Don't use it to gamble. No matter how digital gold Bitcoin claims to be, it's inherently high volatility. Don't treat it as a pension, and recognize each tool's purpose before allocating. That's how you survive long term. Finally, I want to emphasize PGI's launch isn't just a change in how gold is traded. It's a mini revolution in the global financial system. Gold used to be just a store of value. Now, through digitization, it becomes a liquidity tool, tradable, collateralizable, payable, and even eligible as a high-quality liquid asset for banks. This means gold's role in the modern financial system is growing over the next 5 years with Fed rate cuts, global central bank gold buying, and weakening dollar credibility. The gold market will expand, and PGA's potential will too. Historically, every turning point in U.S. interest rates has led to a decade level. Wealth reshuffle from Nixon closing the gold window in 1971 to Volcker's aggressive hikes in 1980, 2-0 rates in 2009, and unlimited QE in 2020. Miss one cycle and you wait another decade. September 2025 could very well be the start of the next cycle. So what do you think? Will digital gold replace physical gold if PGI really launches next year? What percentage of your salary would you put into it? 1% to test the waters, 5% for allocation, or 10% with leverage? Drop your answers in the comments. You'd also love to hear from gold veterans and physical gold loyalists. Who do you think is the real digital gold? Don't forget to like and subscribe. I'm Luna here to translate macro trends into numbers in your portfolio. See you tomorrow. Let's catch the next wealth wave together.